By Richard Eisenberg. Next Avenue. A great feature of traditional individual retirement accounts and employer-sponsored retirement plans like 401ks is that their money can grow tax-deferred for years. But eventually, the tax piper must be paid. That's when required minimum distributions, or RMDs, kick in and federal, plus sometimes state, ordinary income taxes will be due. RMDs are the minimum amounts you must withdraw from your retirement accounts each year. They are the method by which the government ensures you'll eventually be taxed on the money you saved tax-free. Rules governing RMDs are a little complicated and they have changed twice in recent years. First, in 2019, with the Secure Act, and then in 2022 with the Secure 2.0 law. As Christine Moriarty wrote in her Next Avenue article on year-end tax moves, the Secure Act bumped the age to begin taking RMDs from 70.5 to 72 starting in 2020. Secure 2.0 pushed back the threshold even further, to either age 73 for people turning 72 after 2022 or age 75 for people turning 74 after 2032. Your first RMD must be taken by April 1 of the year after you reach the starting age for distributions. Subsequent RMDs have to come out of the retirement plans by December 31 each year. If you choose to delay that first RMD until April 1, you will end up having to take 2 distributions in that second year, noted Amanda Lott and Sarah Backer in their J.P. Morgan Wealth Planning Strategy Advisory. Why taking RMDs on time is so important. RMDs aren't required for Roth IRAs, but they are for people who inherit them. If you fail to take your RMD, you'll be socked with a tax penalty equal to 25% of the amount due. Before the Secure 2.0 law, this excise tax was a steep 50%. The penalty drops to 10% if you make up the missed RMD within 2 years. You can also file for a penalty waiver on Form 5329 with your tax return if you send the missed RMD. You can take your RMD from any of your IRA accounts, or you could take some money out from each one. Personal finance journalist and author Terry Savage said on the recent Friends Talk Money podcast episode on RMDs that I co-hosted with her and Pam Kruger. One exception. If you have money in a 401k or 403(b) employer-sponsored retirement plan, you must take a specific RMD from it. Exactly what percentage of your retirement accounts you will need to withdraw each year is based on a complicated Internal Revenue Service calculation. There are worksheets on the IRS site to determine your RMD. The government doesn't care whether you have $25,000 in your IRA or $2.5 million. The RMD is a percentage based on the amount that's in there, said Savage. Your annual RMD percentage is based on your age and estimated life expectancy. Essentially, the IRS aim is for you to eventually take all your money out of your retirement accounts over your lifetime. But you needn't worry that a huge percentage of your retirement funds must be withdrawn in any one year.